Time for Ask Annex. In the studio, Fred Coleman, CFP and a wealth manager at Annex Wealth Management.
Hey, Danny.
Matt Morzy, he's Director of Research and a CFP. Welcome.
Hey, Danny.
I love this one. Listen to this, guys. Can I join the I Have a Know-It-All Neighbor Club? Because we've had a couple of those.
Yeah,
right?
must be
Okay.
active listener.
Yeah. Mine says I'm foolish to maximize pre-tax contributions because I have to pay taxes in the future, and the taxes will not be lower in the future. He says Roth 401ks are the only way to go. You're a Roth fan. What do you think of this?
Yeah, I'm a huge Roth fan. The only thing that I don't like is the only way to go. When we think about taxes, the biggest factor whenever it comes to your taxes, whether tax rates are high, whether they're low, is your income. So rather than looking at what tax rates will be overall now or in the future, first you do have to take a look at your personal income, because we're far more able to predict that more than we can accurately predict what tax rates will be in the future. And an example is, if we look at what taxes are today, they're lower than they've been in a while. So if you would have invested in Roth, 20, 30, 40 years ago, even though in some instances it wasn't available, you wouldn't have been better off right now just from a purely tax rate perspective. So hindsight is 20/20, of course, but the way that we plan around this is through tax diversification. So instead of going all Roth or all pre-tax, spread your savings out through, various different buckets. And this eliminates the need to guess whether tax rates will go up or go down.
I think this fits in the personal finance part of being very personal, and everybody's situation is going to be very different than anybody else. Even though they're neighbors and houses are probably pretty similar to each other, they might have very different incomes. They might have very different savings rates. They might have different, buckets that are already filled up in terms of traditional versus Roth or taxable, and their picture probably looks really different from each other. And knowing your own personal situation and trying to diversify those different things, even add the HSA into that as well, if you have that option to have, the benefits of that too. You really just want to make sure you have that flexibility later on in life. And I think the point that you're making, Fred, that's really great is that we don't know what those rates are going to be. And what we don't know is where are you going to be then versus now. I mean, if you save a lot in one of those buckets, that might change what that picture looks like later. And your spending in terms of when you're going to do that is going to change. And then you can think too of what do you want to do from an estate planning perspective as well too. For a lot of people, that Roth is that way to give money to their beneficiaries tax-free. For other people, they might have other ways to do that, but that's not important. And you got to go through your own situation and see where you want to be. But what you really want is flexibility, and that's really the key.
It's probably harder when somebody's in their 30s or 40s to even look that far down the road. That's how I was. It was like, I'm not paying taxes now. Yeah. Now that I'm a little farther down the road, kind of wish I would have.
No, it's definitely a challenge. It's a challenge in two ways. It's challenging to look that far ahead, and it's challenging to just voluntarily pay taxes. But usually when you're younger, it is best to go ahead and bite that bullet.
Yeah. Okay. Next question on Ask Annex. My investments are spread across 6 different accounts. Each has a cash position. Is it better to have a single cash position instead of cash within each account?
That's a good question. My first thought
I looked at mine. Mine's sort of kind of like this too, right?
Yeah, and I think for a lot of people it is. They're going to have multiple different types of accounts. For me, when I hear 6, that seems like a lot. You generally a traditional Roth, maybe a taxable account as well too. If you've got a spouse, that certainly can add up as well too. But when I look at it, first, I like that they're thinking big picture. What's my overall allocation look like? And not looking at it too narrowly within each individual single account, because that's going to give you a better idea of what your true allocation is. When you're looking at what that cash level is within there, you also want to think about flexibility and where you might be pulling money out. Or if you're in active distribution mode, you're going to want to have cash in an account that you're going to want that flexibility to pull it out. So if you're in RMDs, you probably would rather have it in your traditional IRA than your Roth, because if you're not pulling money out of your Roth, you really don't need that cash there. And you're going to want at least the money that you need right now from your RMD. Maybe it's a taxable account that you're pulling money out of. But I'd also look at risk tolerance for all those accounts too. So a lot of benefit of having cash in an account is that it smooths out your return sequence. There's no the fluctuation of the ups and downs there. So if there's a certain level of risk you want to maintain, that's one way to do that. And if you're actively pulling money out, that's also why you want to do it there too. But I like the idea of looking at a big picture. You don't necessarily need a lot of cash in every account. You might want some just to provide some flexibility. But ultimately, if you're taking money out, that's probably where you want to have that most centrally located.
Unlike the past, I mean, cash is a legitimate asset class. Now you're going to get something off of it. So just make sure that it's not just pure cash. Make sure it's in a money market, or some type of cash alternative if it's a long-term thing for you.
I guess I kind of always thought it was just dry powder, too, in case there were going to be trades.
Yeah, it can be for sure. But I would look to see the size of that within that account. Dry powder, generally, you can look at it a couple of days for ways. If you're really active, it might be a large portion of that account. But for most people, it should be pretty small.
Mine would be like the little cap gun. That's right. Matt Morzy is Director of Research, CFP at Annex Wealth Management. Thanks.
Thank you.
Fred Coleman, CFP and Wealth Manager. Thank you.
Thanks, Danny.